Good evening and welcome everybody. My name is Stephen and I'm going to be your moderator this evening. I'm excited to welcome Bob Gray as our speaker for tonight for a 2022 year-end tax update. Before we get started and we hear from Bob, I'd like just to mention a couple of points of housekeeping that we can bear in mind. And we'll do our best to get through all of your questions live at the end of this evening's session. The other point in our housekeeping is that CE is not available for this webinar, and that applies to live or on demand. So, Bob, welcome. I'll pass it over to you now.
All right. Good evening, everybody. I hope that we have the California winner of the Powerball on tonight, or maybe not. It would be some big tax questions for that person. Welcome, everybody. I need to start by saying that obviously Henry Schein is not offering individual tax advice here, so I want to make sure that we all know that. The Legal Beagles want to make certain that's true. But I am Bob Gray, and I'm very proud to be one of the founding members of the Academy of Dental CPAs. I've also been an instructor, and this is pre-pandemic, to the ADCPA Business of Dentistry courses. They were previously week-long courses that were held in the Caribbean and in Hawaii, and were really well attended, and we're really looking forward to getting those back on track again. So in the future, so stay tuned. You'll see more about that coming up. Also an instructor at the Dental Business Institute, again, pre-pandemic. Some of these things have gone, Zoom and not live, but I do lecture quite a bit all over. So welcome tonight. I do need to do a quick shout out to my friends at the ADCPA because it's a very interesting group of accountants. People ask me all the time, well, how is a dental accountant any different? Aren't the tax rules the same? But I would tell you that if you look, we're all over the United States. You can go to adcpa.org and find an accountant near you that specializes in dealing with dentists. And honestly, most CPAs really are general practitioners. And so they really don't know exactly how to help dentists. They don't understand mesial from distal and buccal from lingual, and really can't point to tooth number 8. So again, if you're working with an accountant, that does not specialize in that, I'd say give this a try. Tonight, I want to talk about some tax planning considerations, and we're going to save time for questions at the end. But I want to talk specifically about the QBI deduction. That's one of the big takeaways tonight that I want everyone to understand how to better calculate, because that has the potential for some significant tax savings. We're going to talk about the employer retention credit. There's been a lot of flurry about that as well. 179 and bonus depreciation. We're going to talk about maximizing itemized deductions. I have some other little planning tips in here, but let's get started. One of the changes for 2022, there's many changes, a lot of really small technical corrections, some things that were enacted in 2022 that'll be effective for 2023. Things like energy improvements that you do to your home. There's a new $1,200 annual deduction for that. There's new electric vehicle tax credits that are coming into play in 2023. So stay tuned for those. But for this year, one of the things the IRS did was change the standard mileage rate. For those of you who use the mileage rate to calculate your business auto deduction, it's 58.5 cents per mile, but only to the end of June. With the big increase in gas prices, they raised it to 62.5% for the last 6 months of the year. So you'll need to make sure when you're giving your accountant the information about total auto mileage that you split it between beginning of the year and the second half of the year. One of the other changes I want to bring up was this residential energy credit. I mean, we have a lot of clients who have asked questions about solar and how much credit it is. They've just increased it to 30% of the cost for installing qualified electric, solar systems, wind, geothermal, biomass, etc. And for those of you with Teslas or that want to buy the competitor to the Tesla Powerwall, even those charging stations and those battery backups will be eligible for a 30% tax credit. So Uncle Sam's paying for 30% of the cost of making these sort of energy improvements. It's kind of obviously a big deal if you're considering going solar. Let me jump into the employee retention credit claims, though. I think you probably everyone on this webinar tonight has been bombarded by companies claiming that, oh my gosh, you could get $26,000 for every employee you have. Just, come talk to us and we'll make all this money up here. And those refund mills have been popping up. I mean, it seems like there's more of them every day. But I have to tell you, you really have to be aware of the potential consequences. Here's the deal. This is right off the IRS website. Employers warned to beware of third parties promoting improper ERC claims. So if you pay one of these companies, and many of them charge as much as 30 or 35% of the refund. So take an example, like maybe someone got you $100,000 in ERC refunds erroneously. You paid them $30,000 to do it. The IRS then comes back and says, not only do I want the $100,000 back, I also want penalties and interest for the fraudulent claim. And good luck trying to get the $30,000 back from the company you paid to do that if they fold up their tent and go away. So it could really be expensive if it doesn't turn out. I mean, just be very careful in who you're selecting to do these calculations. So let me tell you what it really is, because I want to make sure that everybody understands. We're still within the time period where anybody could go back and retroactively file for the employer retention credit. The statute of limitations is still open. So part of this is a review, but just remember that anybody who had a 50% or more decline in revenue in Q2 of 2020 as compared to Q2 of 2019 automatically qualified for the employer retention credit. That was the one, call it the safe harbor rule, that just says, yes, I definitely qualified. That was for the first wave of ERC. For the second wave, which began in 2021 for the first 2 quarters, you only had to have a 20% drop in revenue as compared to the same quarter in 2019. But many of the practices that we deal with have been pretty much back to full steam in 2021. So there's not, few people were eligible in 2021 under that safe harbor rule. But the rules go on to say that you must have either had that significant drop in income or you had a partial suspension of operations due to orders from an appropriate government authority. Here's the part where these refund mills are sort of twisting this definition to say partial suspension of operations. I've heard some commentators say, oh, well, if I had to spread my patients out farther because of all of the things we had to do to be COVID friendly in our office, that I therefore had a partial suspension. Well, you may have had a reduction in total patient flow, but this is very, very specific. It is an order from a government authority that said you cannot be open. It was a stay-at-home order. Or it's an order, they use an example on the IRS website of a restaurant who had all their tables, 4 feet apart, and now they had to be 6 feet apart. So they were required to take tables out of the restaurant and have a reduction, therefore, in potential revenue in compliance with this government order. But it's going to be difficult for most dentists to ever fall under that order. So what they really would fall under is this example of a government mandate. This was just a chart off of Wikipedia I pulled up, but I wanted to show you. If you see down here on Arizona had a stay-at-home order that started on March 31st, and it was lifted on May 15th. So for any Arizona dentist, that would be a guaranteed time period in which you were qualified for the employer retention credit. The rest of it would be qualified based on income or other circumstances. And again, I didn't want to make this whole thing tonight on ERC, but there's been a lot of misunderstandings about that and a lot of opportunity, though. Make sure that if you haven't applied for the ERC, you've at least done the calculation to see if you qualified. I think the other thing there's a lot of misunderstanding about was everyone thought you had to be in business prior to February 15th of 2020 to qualify for the employer retention credit. Not true. If you started a business up after February 15th, and as long as your gross receipts did not exceed $1 million, and you had employees, which is the basis for this, you're eligible for that credit regardless of whether you had any, you couldn't show income reduction because you just started up. So you just had to start a business during the pandemic and you're eligible for the retention credit. In addition to that, the recovery startup businesses actually got an extra quarter to help qualify. They got the fourth quarter of 2021 where they could actually use payroll as well for that, unlike any other business. The recovery startup business has got an extended quarter. So make sure that if you started a new practice, if you had a new entity that began in the pandemic, post February 15th, 2020, that you do that calculation for you as well. And here's what's in it for everyone. There's in the first wave, which I call, the first wave of ERC, it was 50% of all the qualified wages up to $10,000 per person, per employee that you paid. There was a cap of $5,000 in that 2020 timeframe. For 2021, they jumped the credit to up to 70% of qualified wages, limited to $10,000 for each quarter. And there were 3 quarters in which that could have qualified, Q1, 2, and 3 in 21. So if you were in that perfect storm where you were exactly down 50% in 2020, and then 20%, that's where you get the $26,000 per employee. That's the claim that everyone's making out there. But the only other difference, as I mentioned, the recovery startup businesses have a cap. They're capped out at $50,000 per quarter. Based on the same calculation, though, using $10,000 limit for employees up to 70% of qualified wages. So again, it's a very significant credit. Make sure you've either done the calculation. I know many of you have already gotten your refunds, and that's great, but just for those of you who have not, tread lightly when you go to decide about who's going to file it for you. Let me put it that way. Let me swing over and talk about itemized deductions. For itemized deductions, this is not a big deal tonight, but it's just a small thing. If you know, for 2022, the joint standard deduction is $25,900. That means if you didn't have any taxes, didn't own a home, didn't make any charitable contributions, you still get a $25,900 tax deduction for free. The opposite of that is that you have to go over that in order to get any tax benefit because the first $25,900 is free. So I remind clients of 2 things. One, in this particular example, here's a client who gives $3,500 per year on average to his local charities. And unfortunately, because that limit is exactly the $25,900, they don't wind up getting the actual tax deduction. But if you look at it this way and say, well, what if we had gone with $7,000? If I go to my charity and say, listen, I would normally give you $3,500 in 2023. I'm going to give you all of 2022 and 23 this year. You can see that it would pick up an extra $1,560 in tax savings just by combining your contributions into that year to bump you over the itemized deduction limit. One other thing we need to talk about, though, many people have heard this is called the SALT, this $10,000 limitation here on taxes. The SALT, that's the state and local income tax deduction. Many of you are already paying $10,000 in real estate taxes alone if you own a home. And so you're not getting to tax deduct any of your state income taxes because you're capped at that $10,000. Now in 2022, there's 27 states that have enacted what they call pass-through entity tax rules. That means if I'm an S corporation or a partnership in my practice entity, I could actually have my S corporation pay estimated state income taxes for me in those 27 states and have the S corporation take a tax deduction for those state taxes. And again, for high earners and for big states like California and New York where the taxes are huge, that could be a really significant number. You might be talking about, picking up $50,000 in additional tax deductions just by letting your practice pay pass-through entity tax. And it's the equivalent when you get your K-1, you would just see that I have the normal income, but it's been reduced for federal purposes by that tax deducted amount. However, for state tax credit, it shows up as if it were withholding on your state tax return, and you get tax credit for that. But again, by having the entity pay it, the entity is taking a deduction for taxes, and therefore you're taking a federal tax deduction by lowering your federal taxable income by the amount of those estimated state tax payments. So if you live in one of the 27 states that does have that, You definitely want to look into that. If you're in one of the 9 states with no state income tax, like Florida, don't worry about it. It does not apply to you. But make sure you look up pass-through entity tax for your state and talk to your tax preparer about that. I want to get into talking about purchasing equipment in Section 179. There's always a lot of discussion and questions about that. For 2022, this 179 limit is $1,080,000. So if you bought $1 million or $2 million, you could still only immediately tax deduct $1,080,000. That's still a pretty big number, and I'm sure that for the vast majority of the people here tonight, that may not be a big problem. You can't spend more than $2.7 million to still qualify for this because they're trying to keep the larger corporations out of Section 179. Bonus depreciation through the end of 2022 is still unlimited. Bonus depreciation is another way of saying immediately tax deducting equipment that we bought. And there is no spending cap and there are no rules. And this works for new or used equipment, but it has to be placed in service before 1/1/23. And people say, well, what's the difference between bonus and Section 179? Well, Section 179 was just the original section of the IRS code that created this ability to immediately deduct equipment. The rules have changed dramatically since it was first created, but it started at $15,000, has increased through the years, and now you can see how high it is. When Congress enacted bonus depreciation, it was for a tax boost at the time. It was supposed to be a little economic boost, and it's come into play at 30%, 40%, 50%, 100% deduction. So it's come across the years. The biggest difference for most of you is that the state tax rules treat bonus and depreciation and 179 differently in many states. So it really wouldn't make any difference for federal tax whether I said I took Section 179 for this new piece of equipment or I took bonus depreciation. But it's the state tax that makes the difference. You may not be allowed to take the full Section 179. States like Pennsylvania cap it out at $25,000, and they're still stuck on the old rules. And so again, look at your state tax to see which this must be. The other question that comes up all the time is this: well, when does it have to be placed in service? Well, the IRS says that it has to be plugged in and available for use. Didn't have to actually be used, but the equipment had to either be bolted to the floor, out of the box, whatever it's got to be, and sitting in your office on 12/31 of 2022 to be deductible for 2022. Now, I will tell you that probably there's a few of you out there that drive 56 miles an hour in a 55 zone, right? There's always a little bend to the rules. But the actual requirement from the IRS is that it is actually there and plugged in. I would say I know we have clients who, as long as they paid the invoice and maybe the equipment arrived the first week of January, may have still taken the tax deduction for that. And while it's technically improper, I would honestly say that I'm not sure during an audit how many IRS agents would go through all the effort to take the deduction away from 1 year in 2022 because they'd have to add it back and amend your 2023 return by that time to give you a refund for that year. It's a lot of gymnastics and a lot of effort to go through for the IRS just to get such a small benefit. So it doesn't mean you can ignore the rules, but now you know the difference, and I'll let you take it from there. But I want to give an example of what the actual tax effect is, because I don't think people really realize the cash flow effect when you buy equipment. Let's say that you bought $150,000 worth of equipment on November the 1st. Through many of these financing programs, as you know, you get 6 months of payment free or maybe just interest only, whatever. But for 2022, you'd wind up saving $45,000 in taxes. What you also save, though, is the $10,000 that you'd be required to make in estimated tax payments April of 2023. So by the time you get to April 2023, you've already saved $55,000, and you didn't even write a check yet. You basically just signed a document for a loan for a piece of equipment, and you're $55,000 better off than you were before you did it. So a lot of clients who are concerned about the learning curve on certain technology, you say, well, this will take a little bit of the angst away from that decision if it's right for you, because you got a $55,000 boost in cash flow in order to make that decision happen. Remember, it's also the tax the next year. Your tax estimate, your required tax payments are based on either this year, whatever year you're in, or 110% of the prior year. And so if you lower your prior year's taxes, you also lower the ability or lower the requirement to pay taxes for 2023. So just realize it doesn't mean you don't owe the tax in 2023. But I would tell you that if I got in this example, a $40,000 reduction in the amount that I had to pay for this year, plus $45,000 for last year, I'm $85,000 better off by the time I got to April of 2024. That's a lot of money. And yes, you would, by April 2024, have to pay back that $40,000. But I would argue to many of you, if I give you $40,000 today and say, no interest, no problem, you just give me that money back on April 15th of 2024, that's a pretty good deal. So again, it's all talking about the cash flow effect of making these kinds of decisions. This applies to all entities. I mean, my example, it was an LLC, single sole proprietor. For an S corporation, it functions the same way because the S corporation doctor gets the pass-through on the K-1. C corps can also benefit, but it does take more planning. It's very difficult to get to the end of the year and see exactly this total benefit we're talking about. If you've already been taking salary out throughout the entire year, and now want to try to make a last-minute decision to buy equipment. This is very simple, however, if you would purchase equipment in Q1 of a year and then take your salary accordingly so that you could actually take a reduction in your taxable W-2 income. That's how you get the benefit to pass through to yourself when you're in a C corporation. But this really does apply to every entity. There's nobody listening who would not benefit in the way we've described by making these kind of technology investments. I want to switch over and talk about the qualified business income deduction. If you operate as a sole proprietorship, S corporation, or anything other than a W-2 income, so if you're an associate working on a W-2 for a host doctor, you do not get a QBI deduction. But if you operate as a partnership, S corporation, sole proprietorship, and you have business income, you technically could qualify for a 20% deduction at QBI. Again, that means if I make, say, $200,000 and I'm an associate working as an independent contractor, I can ignore $40,000 of that income, just throw it away like it never even occurred. I get a tax deduction for $40,000 of things I never wrote a check for. I just get to ignore it and pay tax on $160,000. So I'm telling you, it's potentially a really big deal. And a lot of people don't realize it until they get their tax return at the end of the year and look down and see that line on the tax return and go, oh, well, that's how that turned out. But I would argue tonight that if you plan that deduction, if you work to calculate that to your best benefit and maximize that deduction, you'll come out better than if you just wait till April 15th to see how it turned out on the return if you're qualified. For S corporations, you need to plan carefully because remember I said that any W-2 wages don't count towards that QBI deduction. So if I'm a S corporation, let's just say I have, pick a number, $400,000 of total income, net income from my practice after expenses. If I took $300,000 of it as a W-2 and only $100,000 of it as a K-1 or dividend distributions, it's only that $100,000 that qualifies for the QBI deduction. That immediately begs the question, then why don't I just skip taking pay and take all of my income as an S corporation on a K-1 as dividends? But the IRS has very clear rules that you have to take what's called a reasonable salary. So reasonable, I can tell you there's court cases that go on and on and on forever trying to define reasonable. I would argue that reasonable is probably about what you pay any associate. Use a formula that you use in your practice. You can also go to the Department of Labor and look up what the average income for a dentist in your area is. You could argue that the federal government publishing that data sets the standard for, and that's only about 170,000 for most states. So you could keep your W-2 pretty low, but just remember you can't be super aggressive and try to take a $10,000 W-2 and take all the rest as QBI potential income. But plan accordingly. And the PPP loan forgiveness in the years gone by had no impact on that because it was tax-free income anyway. Here's an actual example because I wanted to put some numbers on this so you could get an idea of how dramatic this really is. So let's just take a practice. This first section here is without Section 179, okay? This is someone who's contemplating the possibility of buying $150,000 worth of income before the end of the year. And you can see if their practice net income was $470,000 and they have some itemized deductions, taxable income of $441,000, it's too high. Because if you see above here where it says joint and single, those are considered the phase-out limits. So a dentist who earns more than $440,100 married is not eligible for the QBI. And if you're single, you can see those limits are cut in half. So now I would pay federal tax of $103,940. But let's go on and say, listen, I'm going to make the decision to actually purchase this $150,000 worth of equipment this year. Now, all of a sudden, I've lowered my practice income to $320,000. And with my adjustments, not only did I pick up a $150,000 tax deduction for that equipment, I got a $64,000 tax deduction for free, because now I qualify. My joint income on my tax return is less than that magic $340,000 where that phase out begins, and I got the full 20% QBI deduction. So again, look at how dramatic that is on a $150,000 piece of income just in federal taxes alone. Forget the state tax. I saved $61,301 for $150,000 worth of equipment, and it's all up front all the year that I purchased it. So I just want to make sure you understand how dramatic, expanding your practice, making investments in technology, updating computer systems, whatever it would be. Those kinds of investments have a potential for a really big return when it comes to tax savings. So make sure tonight, if nothing else, that you've made sure that you're going to engineer the outcome of your own QBI deduction this year, if possible. One of the other big tax considerations, if you're looking at expansion, people forget is the deduction for when you relocate. There are two things: cost segregation studies. We'll talk about that in a minute, but also just leaving your existing space could make a big deduction. Let's say that you went into your leasehold improvement, your current rental space, and made $300,000 worth of improvements back in 2011. And now you've outgrown it. But you've been taking that amortization, as they call it, on those leasehold improvements since 2011. But you still have a long way to go. There's a lot of unamortized leasehold improvements. The minute you leave that rented space and go over to your new expanded facility, you get to immediately tax deduct the cost of abandoned leasehold improvements. That would be a $215,000 immediate tax deduction in my example. And again, when you're going on these projects and so the expansion things that have a lot of costs associated with it, just realize this could be a big incentive. This could be part of the benefit, so to speak, in the cash flow of making the decision to expand or move to a new space. Also talked about cost segregation. I call it how to turn studs and drywall into Section 179 immediate tax deductions. Basically what happened was many, many years ago, more than 20, the Hospital Corporation of America sued or took a position on the tax return that said, I don't care that the IRS says that we have to depreciate, all of our buildings over 39 and a half years. It seems ridiculous. If I build a hospital and we put carpeting or flooring in there, that's not going to be there 39 years from now. the ceiling tile probably won't be there 39 years from now. Things are going to wear out. So they just took the position that said, no, we're going to use the reasonable course and depreciate it over its real life. The IRS sued them in court and lost. The court said, well, it does make sense. You should be able to do it over the real life of the piece of equipment or what you are actually trying to depreciate. And to counter that, the IRS came back with a whole number of rules and regulations regarding how you split a building up. But let me just tell you, this is the basics of it. If I had $1 million building and I'm going to tax deduct it and get 40%, let's call it $400,000 in tax savings, I either have a choice. I can take straight line depreciation, $25,000 a year for about 40 years, because there's a half year at the beginning and a half year. It takes about 40 years to do a 39.5 year. That, or with a cost segregation study, in most dental practices, it's very simple. I mean, this is a very, very conservative estimate that 20% would wind up in a 5-year category and at least 1% in the 7-year category for depreciation. Remember that these two categories here are things that are subject to immediate Section 179 or bonus depreciation. That's where you've taken studs and drywall and turned them immediately into a tax deduction. And again, that's going to create about $80,000 in tax savings over the first 5 years. And when do you need it the most? You need it when you just took on this big building project. You've got a big mortgage and a big lump in your throat now. Great time to take the tax deduction now for $80,000. The analyses, you can get an analysis done by several companies for free. They'll show you the cash flow. But the only reason I put all the numbers up here is that it doesn't make any difference whether you own the building, this was an example, or if you leased a building and you did the tenant improvements, you did the build out. It would still qualify and be something you want to consider the possibility of a cost segregation for. Again, just remember, I could either break it into pieces or I have to take it all as a lump if I don't. And I want to make sure you understand. So I ask questions, well, people, what is this? Well, obviously the answer is it looks like an outlet, but the answer is, well, it depends on what's plugged into it. Because if there's a fax machine plugged into it, then that outlet is considered a fax machine. And not only the outlet, it's the wiring all the way back to the breaker, and even part of the building permit costs to get to that point. It might turn into almost a $400 immediate tax deduction. Same thing with decorative lighting like a sconce. This is considered something that's not going to last for 39 years, subject to immediate deduction. All of the plumbing, all of the electrical, and all the infrastructure in your dental building, which is significant, again, becomes dental equipment, not actual building. And that's what makes this so powerful, especially for a dental office where there's so much infrastructure, electrical and plumbing that is feeding the system. What doesn't qualify are load-bearing walls on the roof, and land never qualifies. You can never tax deduct land. So just keep in mind that you probably want to do it. The other thing I would talk about, though, is whether this is because of cost segregation studies or whether you're talking about Section 179 and bonus depreciation. You want to time these deductions and choose them wisely. If you look at the left side of the screen, you'll see that here's the 2022 tax brackets. And you'll notice that the tax, on 12% stops at $81,000 for $81,050 for married taxpayers. That means that you only paid 10% on the first $20,000 and the 12% on the next. I would argue that I think the taxes are on sale when they're only 12%. If someone comes to me and says, "Oh, Bob, I'm so proud I got my income tax down to zero." I don't know if you really did the right thing, because if you used tax deductions, if you took an equipment deduction and you took it against the ability to avoid this 10% or 12% tax, was that really the best return for your investment? Why not hold it and take it against these 35 and 37% tax brackets? A much stronger tax savings for you if you time these deductions. So you don't have to pick. You can, for Section 179 and bonus, it's not all or none. You could have a $150,000 piece of equipment, and you may want to pick exactly $80,815 as Section 179, and the rest you're going to postpone and take over that 5-year period so that you don't have to reduce your income tax down into this 10 or 12% bracket. Pay a little tax when it's on sale. So the other thing about these cost segregation studies is that typically if you already built a new building, you bought a lot of equipment anyway. So doing the cost segregation study and having all this new equipment in the same year kind of defeats the purpose. We're right back to this problem where you're going to wipe out all your taxable income. What we tell clients in that situation is wait until the next year. So if I built a new building and I occupied it in 2022, let the equipment that you purchase be what's going to reduce your income down into that taxes are on sale category. Next year in 2023, do the cost segregation study, because under the current rules, you are allowed to go back and then starting in 23, retroactively pick up all the extra depreciation you could have taken in 2022 and in 2023. So in essence, you're going to get 2 years with huge tax savings if you built a new building and did it that way. So again, time the study or time your deductions accordingly so that you're not knocking your tax down into that 10 or 12% bracket. Here's some new numbers as well for Roth IRAs. The HSA limits for 2022 are $3,650 for yourself only and $7,300 for families. I would tell you these HSAs, as you know, health savings accounts, are for high deductible health insurance folks. And they're really a pretty significant tax savings because they're not income limited. So you can still have pretty high income and still have put away $7,300. The nice part of that is that when you put this money away, if you're lucky enough to have good income and don't really need to tap into that money and just let it simmer and save and it percolates and grows tax-free. And to the extent that it's taken out later in life for medical purposes, it's still completely tax-free. And so I've always tell clients, consider this like an extra IRA account, because most of us, unfortunately, as you get older, you're probably going to use some money for some healthcare costs. Better to have $100,000 sitting in an HSA account somewhere down the road, if that came along, that you've tax deducted throughout the years, and then don't pay income taxes on it when you actually use it. Roth IRAs are $6,000 for this year. And I would tell, again, for people that have significantly high earners, Roth IRAs can definitely be an interesting tool. The benefit of the Roth IRA is that at some point when you retire, you have two different drawers to take money out of. Let's say it's a year where you wanted to buy a new car and you didn't want to you don't want to just jack up your retirement distributions and raise your taxable income so much that year. Well, maybe you'd reach into your Roth account and take the money out to buy that new car. And vice versa. If things were lower, if you had some tax losses, some write-offs, you might want to take more out of the taxable account. So it just helps. Having the sophistication of those two different drawers to reach into for retirement money could definitely be beneficial down the road. Also, contributions to a 529 plan are not tax deductible. There are tax credits for many states for the money that you make to those college savings plans, but it's up to $16,000 per donor that you can put away that is completely gift tax free. Now that's per donor. So if a husband and wife want to give a child $32,000, they could do that every year. And you're also allowed to front load a IRA deduction for about 4 years, or the 529 deductions for about 4 years. As long as you didn't do it in the next 3 years after, you could put 4 years worth of contributions away all at once for a child and then stop for the next 3 or 4 years, and you'd still be under the limits for gift tax purposes. As one exception to the gift tax limit of $16,000. The other thing I see a lot of clients that I would say make mistakes is that they pick the pension plan that suited them when they started the practice. Many people start with a simple IRA plan because it fits. It's the shoe size that fits. I only had $14,000 perhaps and money I could save. I started a new practice. The simple IRA plans are free to monitor. There's no filing requirements with the IRS. There's no other third-party fees. So it's a great way to start. But look what happens if we jump up to the 401k plan and go to $61,000 in deductions, or $67,500 if you're over 50. But again, for the really high earners, look at the $245,000 on cash balance and any kind of defined benefit plan. And I would tell you that the combo of those two plans could really significantly decrease the employee cost in the right situation. If you have an older doctor and an overall younger staff, I've seen situations where the doctor is putting away $245,000. The spouse is also putting money in a 401k, and the total cost to the practice for the staff is less than $20,000. So make sure that you just ask the question every year, do I have the right pension plan? That's important. I'll talk just quickly about a couple of tax deductions that I always see a lot of dentists miss, especially recent grads with LLCs. When you purchased those dental books, the loupes, the articulator, hand instruments, that sort of thing, all of that was done for dental educational purposes, and it's not tax deductible. But the minute you converted those items to business use, they became tax deductible at their then fair market value. So make sure that you've made the list of all those things that you had, because they just need to be available for use. They don't have to actually be used. They have to be in the drawer somewhere in your dental office, potentially capable of being used, and they are business tax deductible. Also, the tuition for a specialty degree. I'm shocked by how many people don't realize that if you actually started as a general dentist, had income as a general dentist, then continue to work part-time, just moonlighting, and go on to train for any kind of specialty degree, that tuition is tax deductible. If you had to basically start as income, and now it's considered continuing education. But if you just went on from your general dental into the specialty program immediately, it's just considered continuing education. It's not tax deductible. So keep that in mind for any of you who are considering the possibility of going on to a specialty degree. Here's another deduction. Way back in the 70s, when the Olympics were in Atlanta, the United States was kind of embarrassed because we didn't build hotel rooms fast enough. And so Congress came up with this idea that said, hey, this is the original Airbnb. How about if we let anybody that wants to rent out their house take a 14-day limit where you can, again, rent your house out for 14 days, and the income is not required to be reported as taxable income. It's completely tax-free. So I don't know if any of you have ever seen, I call it the Extreme Makeover Home Edition, where they come in and basically they remodel somebody's house, and they're always in a big hurry. They're trying to get it done, and it's a super rush. And I always thought, as an accountant, when I saw that person, a very needy person, rolling up the front sidewalk in a wheelchair in the brand new, beautiful house rebuilt, I thought, gosh, how are they ever going to pay the tax on all that, those winnings, so to speak? Then I realized, this is what they're doing. The TV show rents that person's house for 14 days to film a TV show. They demolish it, rebuild it, and again, the money that they got for that rent, which is basically the furniture and appliances and all the things they've done, are free, tax-free to the people that get those winnings on those programs. So good for them. But this can apply to you as well. I mean, if you have a bona fide reason to have meetings, maybe you've got just some full staff meetings. It could be a holiday party you wanted to have at your house. It could just be I want to have my clinical manager and my front desk manager or my associates come to the house and talk about a little strategy for 2023 or beyond. Go to your local, banquet house, country club, or whatever, and ask them, what would it cost me to rent a room here for the day? And then use that as the guideline to reimburse yourself for renting your home. Because if it comes out to be $1,500 or $2,000, your practice could write you a check for $2,000, charge it off as rent, as a deduction. You would put it in your pocket. It would be tax-free. Again, it's only maximum 14 days. I don't think you need to do it exactly, but it's certainly a monthly meeting, something like that if it's appropriate. Just make sure you understand that that's available. One of the other things is family limited partnerships, especially for those of you that own your own building. A family limited partnership is a strange partnership in that because they're all family members, through the rules of attribution, you're allowed to give out income from that partnership regardless of the percentage that you actually owned. So if I had a child who only owned 0.1% of my family limited partnership, they would have no voting rights and no control, but I could just help them. I could, what they call, anoint them at the end of the year arbitrarily and give them 90% of the income. And that would come to them on their K-1 form, not on the parent's K-1 form. Now, again, depending on kiddie tax and the age of the child, that comes into play. However, especially if you've got, 20-some-year-olds that still need help, that can be a great way to do it. It also helps on your estate tax planning as well. And speaking of estate taxes, the current, estate tax exemption is a little over $12 million. I only mention this because Congress has been working on a plan here several times to decrease this. Given the budget and all the things that we've got going on, I can't imagine how they were ever going to fight to increase this in the future. And so if you have a high net worth estate and you want to consider the possibility of making gifts to some trusts or things for children or for beneficiaries in the future, you might want to think about it now, because we've seen in the past where some of these tax enacted are retroactive. So in other words, it may not be in March of 2023. And they also say, well, now the new limit is cut back to 6,000 or 5,000 or whatever they would come back with. However, if you use up your estate tax exemption today and file a gift tax return, they cannot take it away from you with new legislation. So again, for the few of you who are super high in net worth, just make sure you've talked to your attorney and your estate planning and your accountant about the possibility of whether it's, a gift for 2023 would be right for you. I want to leave time for questions here at the end, but I just want to make sure you understand that we just talked about the super highlights of a few things in tax planning. It's very complicated. You really don't want to wait till the end of the year and wait till April to start to talk about this, because otherwise it's obviously too late. You want to, and if you just treat your accountant as I call like an archaeologist, and you just send them information at the end of the year, they blow the dust off what already happened and can't change anything, you're not really taking the best bang for the buck out of tax planning. As I pointed out tonight, new equipment really can have a very big impact on your tax liability. I think the PPP loan forgiveness for anybody who hadn't, that train may have left the station, but choose wisely before taking accelerated depreciation. I want to make sure that you realize that taxes are on sale when they're only 12%. So don't work so hard to get your taxable income down to 0 or below. And you can turn studs and drywall into equipment. So don't forget about the possibility of a cost segregation study. And those cost segregation studies don't have to be done in even year 1 or year 2. You might postpone that to year 3 or 4, because you could still go back and retroactively take the tax benefits of that cost seg study and apply them to that year's tax return when you file. And that's a year when your income is now going up because you're in the new building. You've had a chance to grow. You've had a chance to improve your income. And so that may be even the better timing to make sure that all of those deductions are taken in that 37% federal tax bracket rather than the lower tax bracket. You have my contact information up here tonight. I always say to all of the participants tonight, if you have questions, we're going to take a minute here and try to address a few of them tonight, but take down my email address. If you send me a question that requires 25 hours of research, I'll cry foul and thank you previously. But if someone has a quick question, if they think there's some things we could be helpful with, if they'd like to have their own tax returns reviewed on a complimentary basis, you've got my contact information here. We'd be happy to spend a few minutes and talk to any dentist who we think we might be able to offer some value to, some help. So let me jump out into the questions. Do we have any questions here? Yes.
Hey, Bob. Yes, we do have some questions. We have a question here from Bradley. He asks, what if you purchased a practice in Q4 2020 and Q1 and Q2 numbers were significantly below the previous year periods under the previous owner?
Yes. So the answer is Yes, when you have, for the employer retention credit, the predecessor's revenue numbers are the measuring stick for your numbers going forward. So that if you did not own the practice in 2019, you would still get the revenue totals from the seller doctor and use those as the measuring stick as to whether you're eligible for that 2020 50% reduction in Q2. And also, if that doctor, you're saying in Q4, so if that doctor actually did qualify in Q2 of 2020 for the ERC credit, and Q3, you would automatically qualify in Q4 because you bought the practice. So that could be, you need to get that information from the selling doctor. You would also be able to go on in 2021. And if your January or Q1 of 21 was only 80% in revenue of what Q1 of 2019 was for the selling doctor, you would also be eligible for that next wave of the 70% of wages paid up to $10,000 per employee. The only difference is, remember, you cannot use the same dollars if you got a PPP loan. You cannot take the same wages can't be used for PPP and ERC. But especially if I purchased a practice in Q4, I missed the window for their first PPP loans. You may not have had that be an issue anyway. But yes, you do qualify based on the selling doctor's number. Someone said, can I please explain the ERC again? I would tell you that this is going to be available on recording later. I probably want to go back because I don't want to repeat the whole thing, but trust me, just talk to your accountant about ERC. It only takes a few minutes to do the actual calculation and see if you qualify. One of the doctors says, does it mean that if I rent my house out on Airbnb or other portal for less than 14 days, the rental income is also tax exempt? Correct, if it's your primary residence. It has to be your primary residence, okay? Another doctor says, any tips for the seller of a practice that is attempting to decrease capital gains? That's a really complicated question. I would tell you that there's a whole method beyond selling your practice at the traditional way where you would take cash up front. There are ways to convert a portion of that sale price into a consulting agreement. When you convert a portion of that into the consulting agreement, it is now income that you carry forward into the years post-sale. That income is subject to that QBI deduction. It can be used for future, IRA and pension contributions. It can be used to offset other discretionary business expenses like cars and things. So we have quite a few clients who have done consulting agreements related to the post-sale where they wind up paying very little income tax on any of the consulting agreement. And I would argue that zero is even still better than long-term capital gains tax when it comes to the sale of a practice. You're certainly required to be doing some of the financing, so there's a little bit of a drawback there. But if you trust the buyer, it could be very tax lucrative for you to consider that. So email me if you had a particular question. One of the doctors said, Doug, who can I contact for a complimentary review of my taxes? Again, my information is up on the screen here. You've got my phone number. My email is bob@gpallc.net. We would be happy to take a look and get you on the phone for 15 or 20 minutes and just talk about any opportunities that we think you may. Again, this is not a microscopic look at a tax return. It's sort of the 50,000-foot view. But I'm also just shocked at the number of times that we find things where there was just bad communication. There was things that were overlooked on a tax return. And, we recommend that you go back and file for refunds. I would tell you the biggest one was a doctor who bought a new E40 equipment. And he said, Bob, I thought for sure I'd get a refund that year. I came back and my accountant said I owed $20,000. And I thought, well, how can that be? Well, I looked at the tax return and the doctor had the accountant, because the equipment was so expensive, they assumed it wasn't equipment. They assumed they had done something to the building, and they didn't know what an E4D was. They thought it was the name of a contractor. And so they set it up over 39 years for depreciation. We filed for the refunds of about $63,000 for that doctor, who was very happy to have someone who understood what, CAD/CAM dentistry was all about. So again, those complimentary reviews are truly complimentary. There's no obligation. if you want to have that opportunity, just go ahead and email me or call our office. Any one of the partners here would be happy to take a look for you as well. One of the questions also, is there any benefit if you purchase a dental practice in Q4 of 2022 versus a few weeks later in Q1 of 2023? The easy answer is absolutely yes. If you buy it in 2022, to the extent that the equipment or the equipment portion of the allocated purchase price is immediately tax deductible this year. So if you've already earned a fairly significant income this year as an associate somewhere perhaps, and now you're considering the possibility of buying a practice, you could go on at that point and take a big tax deduction this year for that, the equipment purchase right away, as long as you did it before 12/31/22. So keep that in mind. Yeah, when someone said, can I use an HSA account to buy a saltwater hot tub for my back? The question has always come up, can I put a swimming pool in? Can I do that sort of thing if I need can I get a hot tub? It has to be a specific prescription written by a doctor. So if you had an orthopod who actually wrote a prescription and said that this is required therapy, then yes, the cost of therapy that is required via an RX is part of the healthcare costs that are tax deductible and therefore part of the HSA. But be very careful that you've got all the documents to support that as well. Another doctor asked, if you own building and reduce rent to the S Corp, can it be paid out in a later year? Yes. If you basically gave your S Corporation a break in a prior year and you didn't pay enough, that money does not have to be forgiven. You could come back now and say, yes, I want to pay that money back in rent. And for all you S Corp owners, you want to make sure that you're actually maximizing the rent that you do pay yourself, because the rent that you pay yourself is not subject to Medicare or Social Security taxes. That rental income is separate from the business income from your practice itself. So make sure that you're not giving yourself a break when it comes to the rent. It's also important because if you go to sell your practice someday, it's very difficult to come along and say, oh, well, I used to pay myself $30,000 a year for rent, but now when you want to buy my practice and you want to keep my building, I want to rent it to you for $100,000 a year. So again, you have a significant benefit to try to make sure you're capping your rent at the true market value of the community where you are. And it's easy to come by some of those numbers. You don't have to get a formal appraisal. But make sure that you're being on the highest reasonable side that you can when it comes to calculating rent. I don't see any other questions here tonight, so I would just say to anybody, once again, I think you can see the phone number, 717-263-8713. My email is bob@gpallc.net. If you think we can help, don't hesitate to reach out to us. We're always happy to help dentists. That's what our practice is limited to. So I hope you enjoyed tonight's presentation. Thank you.
Thank you, Bob. Thank you for a wonderful presentation, and thank you to all of you for joining us for this evening's webinar. Now, I know quite a few of you have asked in the Q&A if this webinar was recorded, and yes, it was, and we'll get the recording out to you some point during the next week. One thing we'd really appreciate is just as this webinar finishes, you'll see the opportunity to fill in the survey. We'd really appreciate your feedback. If you could just take a minute to give us your thoughts. So with that, we'd like to say thank you once again. Thank you to all of you for joining us, and we look forward to seeing you on future webinars.